Hi there, accountants. I hope all is well, and I pray that as you are viewing this video that you're in the best of health and spirit. This video will cover Chapter 11, Liabilities, Bonds Payable, from Warren Jones Taylor, Financial and Managerial Accounting. So in this chapter, we discussed bonds, and we know that a bond is the form of interest-bearing note. So much like a note, a bond requires periodic interest payments with the face amount to be repaid at the maturity date. So as creditors of a corporation, bondholder claims of the corporation assets rank ahead of stockholders' equity. So simply stated, what that means, in the event that, let's just say, a corporation is going to file for bankruptcy or they are going to liquidate, before any of the shareholders, any of the owners can receive anything, all of the creditors need to be paid first. So just keep in mind that sometimes corporate bonds, they might differ in the face amount, they might differ in interest rates, interest payments, and dates. And maturity dates. Bonds also differ in other ways, such as whether corporate assets are pledged in support of these bonds. So a bond issue is normally divided into a number of individual bonds. So the face amount of each bond is called the principal, and this is usually $1,000 or a multiple of 1,000. The principal must be repaid on the dates that the bonds mature, and the interest on bonds, it may be payable annually, it may be payable semi-annually, which is twice a year, or quarterly, which is 4 times a year. But for most bonds, they pay interest semi-annual. And the underlying contracts between the company issuing the bonds and the bondholders is called the bond indenture. So the contract could be written in a number of different ways, depending on the financing needs of the company. So 2 of the most common types of bonds are term bonds and what's called serial bonds. So when all of the bonds of an issue, if they mature at the same time, then they're called term bonds. And if the maturity, they mature rather over several dates, then these are called serial bonds. And there's also a variety of more complicated bond structures. So sometimes bonds may be exchanged for shares of common stock, and these are referred to as convertible bonds. And then bonds that may be redeemed by the corporation prior to maturity are referred to as callable bonds. So whenever a corporation issues bonds, the proceeds that are received from the bonds, they depend on the face amount of the bonds, which is the principal, the amount due at maturity date, the interest rate on the bonds, and the market rate of interest for similar bonds. So the face amount and the interest rate on the bonds, these are identified in the bond indenture. The interest rate to be paid on the face amount of the bond is called the contract rate, or also referred to as a coupon rate. The market rate of interest, sometimes is called the effective rate of interest, is similar to the rate determined from sales and the purchase of similar bonds. So the market rate of interest is affected by a variety of factors. This includes investors' expectation of current and future economic conditions. So whenever you compare the market rate and the contract rates of interest, this determines whether or not the bond is going to sell for more than, less than, or if it's going to sell for its face amount. So if the market rate equals the contract rate, then the bonds are going to sell at a face amount. But that's typically not the case. And what happens is that sometimes the market rate is greater than the contract rate. And in such case, the bonds sell for less than their face value. So whenever this happens, the face amount of the bonds is less than the selling price. It's called discount. And if the market rate is less than the contract rate, then the bonds, they sell for more than their face value. And the selling price of the bonds less the face amount is called a premium. And the price of a bond is quoted as a percentage of the bond's face value. So just one key thing to keep in mind is that, again, you have to compare the market and the contract rate of interest to determine if it's sold for more, if it's a premium, if it was sold for less, a discount, or if it was sold for its face amount. So when we're dealing with a discount, this is whenever the bond sells for less than, because the buyers, they're not willing to pay the full face amount for the bonds because the contract rate is lower than the market rate, versus the premium, where the bond is selling at a premium because the buyers, they're willing to pay more for the face amount because the contract rate is higher than the market rate. So again, it's important to be able to distinguish between a discount or a premium and the reasons that drive why investors would pay more or why they would pay less. So as mentioned, the price of the bond is quoted as a percentage of the bond's face value. So for example, if there's $1,000 bond and it's quoted at 98, then that bond could be purchased or sold for $980, $1,000 multiplied by 98%. Versus if a bond was quoted at 109, it could be purchased or sold for $1,090, $1,000 multiplied by 109. So when it comes to accounting for bonds payable, bonds, as we mentioned, they can be issued at their face amount, a discount, or a premium. Whenever bonds are issued at less or more than their face amount, the discount or the premium needs to be amortized over the life of the bonds. And then at the maturity date, the face amount needs to be repaid. So in some situations, a corporation, maybe they'll redeem the bond before their maturity date by purchasing them from investors. So when the contract rate of interest and the market rate of interest are the same, the bonds will sell at their face amount. So not really much that needs to be done, right? The market rate of interest is equal to the contract rate. So in such case, since the contract rate of interest and the market rate of interest are the same, the bonds, they sell at their face amount. It's pretty much straightforward. We debit our cash for the cash received. We credit our bonds payable for the liability. And then every 6 months, or if they choose to pay interest quarterly or annually, they simply debit the interest expense and credit the cash amount. And then at the maturity date, the payment of the principal, we debit our bonds payable liability and credit the cash. But whenever bonds are issued at a discount or a premium, there's more work that needs to be done as it relates to the accounting because we need to amortize the bond discount or the bond premium. So if the market rate of interest is greater than the contract rate of interest, the bonds are going to sell for less than their face amount. And as mentioned previously, this is because the investors, they're not willing to pay the full face amount for the bonds because it pays a lower contract rate of interest than the rate that they could earn on similar bonds, which is referred to as the market rate. So the difference between the face amount, the principal, and the selling price of the bonds is called the bond discount. And then we have what's called the carrying amount. And the carrying amount of the bonds payable, that's the face amount of the bonds, less any unamortized discount or plus any unamortized premium. So when it comes to amortizing this bond discount, we need to have this account called discount on bonds payable, and it's a contra account to our bonds payable, and the normal balance is a debit. So as we pointed out, the carrying amount of the bonds payable is the face amount less any unamortized discount or plus any unamortized premium. So every period, a portion of the bond discount needs to be reduced and added to interest expense in order to reflect the passage of time. So this process is called amortization. So it's really similar to depreciation. So it increases the contract rate of interest on a bond to the market rate of interest that existed on the date that the bonds were issued. So we have two methods of computing the amortization for a bond discount. We have what's called the straight line method, and we have what's called the effective interest rate method. Sometimes it's simply called the interest method. So with the effective interest rate method, it's required by GAAP, generally accepted accounting principles. However, straight line method may be used if the results don't differ significantly from the interest method. So the straight line method is what we essentially use in this chapter, but the effective interest rate method is described and illustrated at the end of this chapter. So with the straight line method of amortization, it provides equal amounts of discount or premium to be written off to the interest expense each period. So the effect of the discount amortization, the goal is to increase the interest expense on every semi-annual interest payment. So in effect, this increases the contract rate of interest to a rate of interest that approximates the market rate. As the discount is amortized, the carrying amount of the bond is now increased until it equals the face amount of the bonds on its maturity date. So one key way to think of this is think of it as though you borrowed money from the bank. You borrowed $1,000 from the bank, but that's not how much you're going to pay, right? You're going to pay them maybe 1,000, 200, 1,000, 1,500, sorry, 1,500, 1,500, depending obviously on what your interest rate is. But your face amount of the loan remains the same. It's $1,000, but there's interest that was paid on top of that. So when we're dealing with these discounts in the bond premiums, the face amount that is going to be paid remains the same, but maybe the investors paid less, you have a discount, or maybe they paid more, you have a premium. But the key thing is that when we net our discount or our premium on bonds payable contra account with our bonds payable account, the face amount at maturity must total the principal. So the effect of the discount amortization, as we pointed out, is to increase the interest expense, and on the date of maturity, the face amount is going to be equal to the principal. Next, we have bonds issued at a premium. So if the market rate of interest is less than the contract rate of interest, the bonds are going to sell for more than their face amount. And this is because the investors, they're willing to pay more for the bonds than a higher contract rate of interest than the rate that they could earn on a similar bond. So again, simply stated, the market rate of interest is less than the contract rate. So because the contract rate of interest is more than the market rate of interest, then the bonds are going to sell for more than their face amount. So much like bond discounts, a bond premium, it must be amortized over the life of the bond. The amortization of a bond premium, it decreases the contract rate of interest on a bond to the market rate of interest that existed on the date that the bonds were issued. So the effect of the premium amortization is to decrease the interest expense on every semi-annual interest payment. So again, it might be semi-annual, twice a year, once a year, or it might be 4 times a year each quarter. So in effect, this increases the contract rate of interest to a rate of interest that approximates the market rate. So next we have bond redemption. Corporation, as we stated earlier, maybe they might redeem or they might call the bonds before they mature. So this is often done when the market rate of interest, if it declines below the contract rate of interest. So in such cases, the corporation, they decide, hey, you know what, let's just issue new bonds at a lower interest rate, and then we'll use the proceeds to redeem the original bond issue. So we also have what's called callable bonds, and these bonds can be redeemed by the issuing corporation within the period of time and at the price that's stated in the bond indenture. So normally the call price, it's above the face value. So for a corporation, they'll usually redeem its bonds at a price that's different from the carrying amount or the book value of the bonds. There might be a gain or there might be a loss realized. So if there's a gain, the gain is recorded if the price paid for the redemption is below the bond carrying amount, and there's a loss if it's recorded price paid for the redemption is above the carrying amount. And if there's a gain or there's a loss in the redemption of bonds, it's reported in the other revenue expenses section of the income statement. So our bonds payable, as we know, anytime we see the word payable in accounting, we know that that denotes a liability, an obligation. So bonds payable, they're reported as liabilities on the balance sheet. So any portion of the bonds that's due within a year, it's considered a current liability. Any bonds that are, going to be paid off in more than a year, that's a long-term liability. Any unamortized premium is reported as an addition to the face amount of the bonds, and any unamortized discount is reported as a deduction from the face amount of the bonds. So there will always be a description of the bonds that's reported either on the face of the financial statements or in the accompanying notes. So next we have analysis for decision making. So sometimes the assets of a company, They're subjected to the claims of the creditors and the rights of owners. So as mentioned at the beginning, God forbid if a company, a corporation goes through bankruptcy or liquidation, whatever they have, creditors need to be paid first, and then the owners will be able to get what's left, if anything. So as creditors, bondholders, they're primarily concerned with the company's ability to make its periodic interest payments and repay the face amount of the bonds at its maturity. So analysts, they assess the risk that bondholders won't receive their interest payments by this formula we see here. And it's the times interest earned formula. In the numerator, we have our income before income tax plus interest expense divided by the income expense. And this ratio computes the number of times that interest payments could be paid out of current period earnings. So when there's a high value of this ratio, it's considered favorable, whereas if there's low values, then it's considered unfavorable. So values of this ratio less than 1.0 suggest that the firm is unable to cover interest payments from current period income tax. So now, if I'm an investor, if the ratio is less than 1, I more than likely will not lend money to this company. So a key thing to distinguish is between stocks and bonds. So when you have stocks in a company, that represents ownership. When there is a bond, that means that you lend money to a corporation. So it's very important to understand the distinction between the two. Stocks, you have ownership in a corporation. Bonds, you lend money to a corporation, and they pay you interest. And with stocks, they pay you dividends. All right, so with this Appendix 1, here we see the present value concepts and pricing of bonds payable. So whenever a corporation issues bonds, the price that the investors are willing to pay for the bonds, it depends on the following: the face amount of the bonds, which is the amount that's due at maturity, also referred to as the principal, the periodic interest rate to be paid on the bonds. It can be quarterly, 4 times a year, semi-annually, twice a year, or annually, once a year. And then we have the market rate of interest. So an investor determines how much to pay for the bonds by computing the present value of the bond's future cash receipts using the market rate of interest. So a bond's future cash receipts includes its face value at maturity plus the periodic interest payments. So the concept of present value is based on the time value of money. So the time value of money concept, it recognizes that cash received today is going to be worth more than the same amount of cash to be received in the future. So present value is the current worth of a future sum of money or stream of cash flows given a specified rate of return, and the amount of money to be received in the future if you make a deposit now. That is called the future value. The present value of an amount to be received in the future can be determined by a series of divisions or by using a table of present values. So we have the present value of $1. That table is used to find a present value factor of $1 that's to be received after a number of periods in the future. And this amount can be received, this amount to be received is then multiplied by the factor to determine the present value. And whenever there's a series of equal cash payments spaced equally in time, that's called an annuity. So let's say you're receiving $1,000 each year, $10,000 each year, $1,500 each year. It's an equal cash receipt that's spaced equally in time. That's referred to as an annuity. So the present value of an annuity is the sum of the present values of each cash receipt. And we have this present value of an annuity of $1 table that can be used to find the present value of an annuity. So the present value of an annuity is calculated by multiplying the equal cash payments times the appropriate present value annuity of $1. So I know a lot of this is theoretical. The best way to understand this is to actually look at the present value tables, so you can essentially see we have what's called an ordinary annuity, and then we also have what's called annuity due. And it's important to be able to distinguish between the two. So when we have annuity due, The major difference between the two is that ordinary annuities, these payments are made at the end of a period versus annuity due payments, which are made at the beginning of a period, right? So a great example would be ordinary annuity payments. This includes loan repayments, mortgage payments, bond interest payments, and dividend payments. Again, so the key distinction is that ordinary annuity, the payments are made at the end of the period versus annuity dues, where the payments are made at the start, the beginning of the period. All right, so as it relates to pricing bonds, the selling price of the bond is the sum of the present values of, as mentioned, the face amount of the bonds due at the maturity date, plus the periodic interest to be paid on the bonds. So the market rate of interest is used to compute the present value of both the face amount and the periodic interest. So when we use this effective interest rate method of amortization, it provides a constant rate of interest over the life of the bonds. So this is in contrast to the straight line method. Again, think of it like depreciation. If you have a, let's say equipment, the equipment is worth $5,000, or the cost rather of the equipment is $5,000. And let's say you anticipate that it's gonna last 5 years, you take equal depreciation of $1,000 per year. But that's not necessarily, the decline in value, right? Maybe the equipment is going to work amazing within the first 2 years, and then in the last 3 years, it'll lag a bit. So in such case, you'll use a method of depreciation that more mimics the usage or the decline in value of the asset. So maybe you'll use a double declining balance, right? Method of depreciation. So likewise, with this effective interest rate method, it allows for a constant rate of interest over the life of the bonds versus the straight line method. So this brings us to our last slide. When we're using this effective interest rate method of amortization, the interest rate used in the effective interest method of amortization, sometimes as mentioned, is called the interest method, is the market rate on the date that the bonds are issued. And our carrying amount of the bonds is multiplied by the interest rate to determine the interest expense for the period. And the difference between the interest expense and the interest payment is the amount of the discount or the premium to be amortized for the period. So again, a lot of this is theoretical, and the best way for you to gain a deeper understanding of this is to go through some of the problems in practice. You will see these theoretical concepts apply. So this brings us to the end of chapter 11, liabilities for bonds payable.